have not talked to you before, so I don't know whether are you already doing a lot of multifamily? I know that you have a real estate portfolio, which is mainly multifamily, or is it?
Yeah. So yeah, I started off in single family homes, just
Uh-huh.
like you.
Mm-hmm.
I'm in an expensive
Mm-hmm.
market
Mm-hmm.
in
Mm-hmm.
California, from the Bay
Mm-hmm.
Area, Los Angeles.
Mm-hmm. Mm-hmm.
And, you know, it, the houses here are like $1 million at least, just like Seattle. I know Seattle's probably close to
Right.
800 to $1 million. So I just started off.
Okay, okay. I'm sorry, my daughter is,
Oh, no worries.
yeah,
You
yeah,
should bring her on too.
yeah, yeah. No, she's actually, yeah, she's a little young to learn right now, but I'm pretty sure yeah,
Yes, start them when they're young, so they can take over your
right.
portfolio.
That is absolutely that. Yeah, I just wish I knew all about real estate like 10 years ago, then I would have been a very different position what I am right now.
Yeah, no, I mean, never too late, to be honest. I mean, there's always a good time to start as long as you can give yourself at least, 20, 30 years, then that's when you start to see the benefit of real estate. But yeah, just like you, I start off in single family homes. I just want a place for myself to live. So, I bought a house with 10% down because it's, more affordable. It's a little cheaper. It's more attainable. It's between 80 to 100K down. And for me, every time I got a new job, which is very relatable, I would just buy another house with 10% down and rent out my
Yeah,
prior house. A lot of people do
yeah,
that, right? I talked to a lot of
right,
people, or a lot of people, like maybe your situation, maybe you lived in a smaller house, and then as your family grew, you want to upgrade to a bigger house, and you just rented out your last house as a rental property.
right,
That's
right,
very, very common, very, especially the Bay Area, very common. And, after doing that, like 3, 4 times, you kind of hit a point where, California, Seattle, it's a little bit harder to cash flow,
right,
um, especially if you're doing long-term rentals. If you're doing, midterm rentals and renting out to contractors or short-term rentals, there's some potential to make more money, but it's more active, right? It's a
right,
business in a
right,
sense. So for me, since I still work at full-time W-2, as a pharmacy director in a hospital, as a pharmacist, I just said, well, I want to get more cash flow. So that's when I started doing multifamily out of state. So
right,
what I did was I looked in Oklahoma and I got 2 apartment complexes, a 26 unit and a 20 unit, and I got them for under $500,000 each. So to me, it was just a little bit a mindset shift because I've been spending $1 million to $1.5 million in the Bay Area. But in Oklahoma, I can get a 26 unit apartment complex for like $500,000, which is like the cost of a condo or a townhouse, depending on your market.
right,
So, and then obviously, if you have 26 units averaging $500 in rent, then that's 13K gross. So that's when I made the huge pivot from single family homes to multifamily, because number one, do you know how single family homes are valued? Like how you evaluate the single family home?
no, I don't know.
So the value of a single family home is based on what your neighbor's house sells for,
Yes, that's right. The
right?
comps, yeah,
It's called sales comps. So if your neighbor house sells for $1 million, good chance your house will sell for $1 million, assuming it's the same size, same square footage. But for multifamily, so by multifamily, I'm referring to 5 units or more. So one unit, duplex, triplex, fourplex, the value is based on sales comparables. So what your neighbor's house sells for. For multifamily, which is 5+ units, the value is based on the income, the net operating income divided by the market cap rate. So it's just simple math, right? Net operating income is your gross rents minus your expense, and market cap rate is dependent on your market. So we're in high cost of living markets, right? California, Seattle. Our cap rates are lower because our properties make less money overall. So for
right,
example, California is a 4 cap market versus Oklahoma is an 8 cap market. So what does that mean? That means that Oklahoma, is more likely to have double the cash flow as California because values don't go up as much in Oklahoma, right? So if you know that equation, net operating income divided by the market cap rate, now I have 2 apartment complexes. One apartment complex gets $10,000 a month. One apartment complex gets $5,000 a month. How are those valued now? The one that gets double the rents is worth double the value. So if you do the math, the more units I have, and I can increase the rents of more units, like let's just say I increase my rents by $200 per unit and I have 20 units. That's $4,000 more in rent times 12. So that's almost like 50K in NOI. Then you divide that by 8 cap, and that's how much value you just increased your property by. So once I understood that concept, multifamily made sense to me because in single family homes, it's either cash flow or appreciation, never both. If you buy a single family home in California, Seattle, it's appreciation only, cash flow, not really.
Right.
If you buy a single family home in Oklahoma, the Midwest, it's cash flow only, no appreciation. But with 5+ units, multifamily, as you increase your cash flow, you increase your net operating income, you increase the value. So you have both. So once I learned that concept, I just said, oh my, like I need to only buy multifamily. Right? Like, don't get me wrong. Like you can do well buying.
I understand. No, I totally understand. Yep. I totally get it. Yep. Mm-hmm.
Yeah. Like you could buy a 4-plex with 10% down, live in one unit and rent out the other 3. That's the beauty about, single family homes, duplex, triplex, 4-plex. But once you're 5+ units, you have to put 25% down minimum.
Right.
With single family homes, you do less than 20%. Yeah, that's it.
Sorry, I lost you. Yeah. Okay. So what is the state of multifamily currently? Because people are saying don't go beyond 5 units because, of the interest rate, and then are the numbers still working in certain states or cities?
Well, because multifamily is based on the net operating income divided by the market cap rate. So during times like right now, interest rates are going up, right? When I was buying in 2021, interest rates were like 4%, or less. Single family home was less than 3%.
Right.
But today, I just refinanced my 20-unit apartment complex. My interest rate was 7%, and that's considered good today.
Right.
Realistically, you're like 9.
Right.
So, if interest rates go up, typically cap rates will go up. So the values of apartments, multifamily will go down.
Down, right.
So when you analyze a multifamily deal, the lenders, they look at it, something called a debt service coverage ratio. And they want that ratio greater than 1.25. And they want it 1.25 of the net operating income. So if your net operating income, if your monthly debt is $1,000 a month, your NOI must be 25% higher than that. So that's $1,250. So you do the math, right? And that's how you can figure out how to make an offer on the multifamily deal, because that's how the lenders underwrite it. Either A, you assuming 25% down to calculate that debt service coverage ratio 1.25, or you can make a bigger down payment and have a smaller loan in order to hit that debt service coverage ratio of 1.25. So, like what I kind of tell people, pick your poison when you invest in real estate. When interest rates are low, what happens? There's more competition.
More, right.
Overbid. Right? People in California, in 2021, in California, it would list for like 1.5 million. The final price would be $2 million. People are overbidding by $500,000 because interest rates are so low. You can afford to overpay and still qualify based on your debt to income ratio. So that's why I tell people, like, people tell me, Steve, interest rates so high, I don't want to invest in real estate. I'm like, well, if interest rates are high, less competition. You just buy right and then refinance when rates drop down in, 3 to 5 years.
Right.
So as long as you buy right, you can't lose.
That's true. You have to make the numbers work.
Yes, as long as you buy right. So with multifamily, you can buy it under market value, and then you have the ability to renovate these apartments and raise the rents, which forces appreciation.
Right.
So how safe would you feel? Like my 26 unit apartment complex, I bought it and it appraised at $200,000 over what I bought it for. And I have the ability to raise the rents by $200 per unit times 26 units. So essentially, my apartment complex I bought for $500,000.
Mhm.
I'm putting in $300,000 to renovate it, and it's gonna be worth $1.5 to $1.6 million. So that's how you buy it with instant equity day one, but also have the ability to force appreciation. If you can do that strategy, it doesn't matter how the market is. It doesn't matter what the interest rates are. You will make money, right? So that's it's really key. But the hard part is buying right. It takes
Right.
patience. It takes a lot of offers, to be honest, and submitting it.
All right. So do you have any besides multifamily, do you have any short-term rentals also? Or
No, I don't. I didn't go down the short-term rental route. I'm definitely. I own a mobile home park as
Okay.
well, actually. But I do own 5 single-family homes in California, and a lot of my single-family homes are near hospitals.
Okay.
So I have been thinking about midterm rentals
Right.
because it's kind of like the best of both worlds, where
Right.
you get a little bit more cash flow than long-term
Then
rental, but
Right.
they stay a little bit longer.
Right.
Yeah, but so far I've had really great long-term tenants, but if they do
Okay.
leave, I am considering it just to get a little bit more cash flow.
Right.
And but it comes with other headaches too, right? Because if you rent by the room to, let's say, a bunch of nurses, there's gonna be complaints, typical roommate, complaints that
Yeah.
you have. So it's
Right.
a little bit more
Right.
work for
Right.
sure, but you can definitely increase your cash flow. So, once my apartment portfolio stabilizes, because I'm renovating a lot of units and renting them out, and in the process of trying to sell my mobile home park, to offload that. But once that's stabilized, I am considering, maybe trying it midterm rental, short-term rental, but just right now it doesn't make sense because I'm doing so many different things between my day job and all that. But I have seen people use like virtual assistants overseas and pay
Right.
them like $5-6 an hour.
5
They're based in
hours.
like like they're based in the Philippines or Pakistan, somewhere in
Right.
those areas. And basically, because property management for short-term rentals, I interview a lot of people who do short-term rentals. They take 30% off your top, and it's really
Right.
hard to make that work. And
Right.
but it's hard because like with Airbnb, you can't just be like a normal house. You have to create like a
Right.
unique experience. So I think
Right.
midterm rental is more appealing to me in that way because as long
Right.
as you're in a good location, like one of my homes, it's nearby a Stanford hospital. So that they're going to bring in travel nurses
Yeah.
there, and
Absolutely. Yeah.
it's really close by. And nurses they work a lot. They work 12-hour shifts, and then basically
Right.
they go home to
I
sleep.
heard. I heard the demand for nurses, traveling nurses, has gone down after the pandemic, and the amount of salary that they get is probably so rent by room would be a good strategy for traveling nurses now.
Yeah, I mean, I have an unfair advantage. I work in the hospital,
Yeah,
so
that's true.
I
That's
kind
true.
of know that. I think during COVID, it was just a little abnormal because nurses were getting sick with COVID, and we had to quarantine for like
Right.
2 weeks
Right.
almost.
Right.
So
Right.
now they uplifted those restrictions. So I mean, there always, to be honest, from my experience, there's always a need for nurses because nurses call
Right.
out sick, and the ER is usually short, the ICU is always short. So there's always a need for travel nurses, but the pay isn't as much as it was. It was kind of inflated, supply and demand. So
Right.
there was low demand, low supply, high demand. So nurses were getting paid more than physicians, to be honest.
Right.
But now there's still demand, but it's just not as crazy as it was before. And usually the agency, the travel nursing agency, will cover their living expense for them. So if you partner with agencies, that's why I really thought about it. Cause like, you know, I either I can just sell one of my single family homes, take the equity and buy a multifamily, or that's probably the most cash flow, but it's more work, or I can make that into a midterm rental. So I don't know yet what I want to do, but that's something I've been thinking about and something that I've been learning about. Because a lot of people that I've been interviewing, if you check out my YouTube channel, they do short-term rentals, and they, you know, hit like good cash flow, right? Because if you average $5,000 net per short-term rental, you get 4 of those. You know, you're getting $20K a month, which replaces most household incomes, right? Good.
Right. Exactly. Exactly.
And with short-term rentals, you know, if you're W-2, it offsets your active income.
Active income, right?
Because it's an active business, right? So that's why I said, so I've been thinking about it too, because I do work a full-time W-2, and
that's a lot.
Yeah, like I pay a lot of taxes to Uncle Sam, and right now I have a lot of passive losses, but I can't offset it because it just carries forward every year.
Right.
So that's why I've been thinking, I'm like, if I convert one of my single family homes into a short-term rental, I just can take those losses off my active income. But you know, it requires more work and more systems. So I am selfishly trying to learn and do it, but my single family homes, a lot of them have HOA. So so that's why midterm rental is the middle ground. You're more cognizant of HOA, but who knows? It still might complain, right? Because your neighbors will know if, like, hey, there's someone new here every, like, you know, 3 months.
A month or
that's right. I do have one that's not HOA, so that one could be like a good, you know, test one. And it's closer to me actually. So, you know, I've been thinking about it, but right now I just don't want to lose focus off of my apartments. That'd be kind of my advice for you too, is like, whatever you pick, just commit to that one and do it for a long time and you'll be successful at it. Like, but for me, I bought a mobile home park, and because I'm splitting my mind between apartments and mobile home parks, you're not going to do one as great. Be great at one thing or good at 2 things, kind of same concept. So because of that, you know, my mobile home park was taking a lot of time, taking a lot of energy, and that's why I decided to sell it. Had I just bought another apartment complex in Oklahoma, I would be in a lot better of a position than I am today.
Right.
But, you know, with real estate, I'm sure like you get excited, you learn about new things. And you want, that's the personality of us real estate investors. But I'll tell you from personal experience, like, it's not better. Just commit to one, whatever you like, do it and scale that, and you'll do fine, wherever that is. You don't need to like do multiple markets. You can pick one market, one asset class, and be fine. Like, I just can do apartments in Oklahoma and have enough wealth that I know what to do with. There's no need for me to do like a mobile home park in Oklahoma as well, or like self-storage, or, you know, so that's kind of my advice. You know, I've been burned from that, you know, in the process of a mobile home park. And, you know, after all that work of 2 years, at best, I'm breaking even. I learned a lot, but, you know, had I put that money into another apartment complex, I would probably be a lot less stress, a lot less work, and it's copy and paste. Because how I do one apartment complex is how I do all 3 apartment complexes, versus how you do your apartment versus how you do your mobile home park is different too. And different property managers as well. So that was kind of, you know, a lesson that I learned. And, you know, it's
actually,
a hard lesson
that is a great piece of advice, Steve. That is one of the best pieces of advice that you have given me, because, you know, I exactly understand. So I just started my real estate journey last year. I have like a duplex in Dallas. That is how I just started, and it's on a long-term rental. And so that's my other problem, that I have to kind of, get the, tax benefit for the active income for the W-2. That is the only reason I was thinking of short-term rental. So otherwise, like, there's no other reason. So you're absolutely right that, you know, stick to one asset class, and even within one area, you know, if you know the area well, you know,
Because for me, I have to talk to 3 different property managers every time. Imagine if you talk to one property manager and they manage all your assets. It's a once a week conversation or once a month conversation, and it's just so much scalable. And then you know the market very well. Like I know in Oklahoma City, it's about 4 hours from Dallas. A renovated 2-bedroom, 1 or 2 bedroom gets you $700, $800. And I know exactly how much it costs to renovate that unit. And I have the team to do it. And I know everything, right?
Right,
So
right.
that's what I mean. Like whatever you decide, just commit to it and scale it. And it's okay, right? Like you do that, you'll be successful. So like that's, you know, it costed me like 2 years of blood, sweat, and tears to do that lesson. You know, you hear it a lot, but I'm the type where I have to like fall and and do it. Cause you know, to me, I was just like, oh, this deal's amazing. Like, and yeah, it would have been amazing if I had like, you know, multiple other mobile home parks and I already had a system in place. But because it's just me, you know, I don't have a system in place yet. So that's why I just said, had I just put that same money in buying a 50 unit apartment house, Oklahoma, like at this point, I could potentially even not even have to work, right? But because I had that distraction, you know, I'm where I'm at today. You know, I still work. I don't mind working, but you know, I set myself back a couple of years. But in the grand scheme of things, you know, relatively speaking, relatively young still. So, you know, if you make the mistake now and learn a lesson today, I still have, you know, 30, 40, 50 more years of this principle and this concept to move forward. So that's why I know now, like, whatever I decide to do, just do it. And I say pick where you have an unfair advantage. I had an unfair advantage in Oklahoma City because I had a good property manager there. That's it. You might have great connections in Dallas where they could give you great duplex, triplex, fourplex, maybe a 5 unit. And if they consistently give you good deals and you know the market, great, scale there. You know, on the flip side, if let's say you don't want to do Dallas, then you can pick whatever market you want. You can eventually sell that property, 1031 exchange it into whatever you want to do it. So there's nothing wrong if that's not the market you want to be in. And
Right.
you know, another thing too is like, not sure of your situation, but like if you and your you know, husband or significant other, like if one of you cut down to part-time, right? So I'll just throw a hypothetical scenario. Let's just say
Like
you're
reps, like a rep,
you're
like a rep status, rep status, right?
correct. So to be
Right.
reps, like for me, I'm single and I work full-time W-2, so I don't qualify as a reps. But let's just say I got married and who I married stays at home, or they work only 20 hours a week or less. So it's part-time. So at that point, they qualify as a reps. So we collectively qualify as a reps. So if you do the math, it's kind of crazy. So if let's just say I make 100,000, let's just say for simplicity, you know, I pay, let's say I make 200,000, 50% goes to taxes. Let's just make it
Tax,
easy.
right.
Right?
Right.
So that's 50. So I basically pay $100,000 of taxes, but I net $100,000
Right.
after taxes.
Right.
And if I buy a real estate, and let's just say my significant other makes $200,000 as well, same thing, right? But let's say she cuts down to part-time, she's only making $100,000 now. So she pays 50K in taxes, but then we can write off, because we qualify as a reps, all that real estate. And if
Right.
I can write off $350,000 of active income, cut that in half, you just saved about, you know, almost, you know, $200,000 in taxes net.
In taxes, net, right,
Taxes,
right,
net, right.
How
So that's why I
many?
said sometimes it's worth it to cut down, for one of you to cut down to part-time, and you get to document your hours, like make it
Right.
believable. Like I only work whatever 16 hours on this job, and then on my real estate portfolio I spend this much. But you have to have a big portfolio to be believable, right? Like me, it's
Right.
believable. I spend
Right.
a lot of time with 90 units that I own.
Right.
So you have to document your hours to
Right.
prove it. Yeah.
So reps, I know that they have the certain limit, like 750 hours or more than anything else you have to work in real estate, you know, for reps qualifying status. Would be like, you know, like 1 or 2, if you buy like one apartment unit, like 10, 12 units, that would not qualify as reps or something, right?
It's just the amount of hours that you
Hours.
document. So, I mean, obviously in the beginning, when the first 2-3 years, when you buy an apartment complex and you're renovating it, you're spending a lot of time,
Right.
right? You have to fly out there, you know, do an inspection. You talk to your property manager, you document all these hours. And so the hard part of the reps, so reps is real estate professional status for those listening.
Right.
And
Right.
the hard part is it has to be the majority of your time. So if I'm working 20 hours a week, I have to do real estate related activities for 21 hours a week. So if, let's just say you don't quite get there, I mean, yeah, you might have to get like a real estate license, but if you have a large enough portfolio, you don't need the license. And like me, I easily qualify, you know, for the rep status. So, you know, definitely I'm not a CPA. I just know at a high level, but
Right.
that's probably the best. That's my experience. Just document it. And like I said, sometimes do the math. Like if one of you cut down to part-time and you qualify for reps, like that, you might end up taking the same home money that you did versus both working. And then one
Right.
of you is part-time and it's nice, right? Like for
Right.
pharmacists, we can become
Right.
part-time and it's nice. Or maybe one of us can like be full-time, one can be part-time. So I've seen people do that a lot where, you know, with that, but, or the other loophole is you buy short-term rentals and you can still both work.
Right.
And then, you know, offset that income there. So,
Mm.
you know, and then, you know, if you get kind of fancy, you can do like corporations and, you know, pay your kids to like help you do stuff,
Help
right?
you.
And
Right.
more tax,
Right. Right.
more tax benefits on
Right.
that end. So,
Right.
yeah, that's
Right.
kind of my experience. Ironically, I actually don't use a CPA. I actually do my own taxes on TurboTax.
Yeah.
I like to actually learn and read myself, but
Right.
obviously, you know, you can make mistakes too, but you know, once you do it, you know, I've been doing it for the past 5 years. It's not bad. Sometimes I'll file it myself and then I'll just like hire a tax attorney for like an hour of their time just to go over it with me once it's kind of like
Right.
done to see if it makes sense.
Right.
So, you know, it's